On 16 May, as the world watched India's decision, celebrations erupted at New York's Times Square. There were cheers and impromptu jigs, as India chose a stable government after 3 decades, giving a majority mandate to the BJP. And when the world's third largest economy elected Narendra Damodar Das Modi as its Prime Minister, the global leaders let bygones be bygones. The US President was one of the first to congratulate Modi, and foreign investors reposed faith in his pro-development approach, extending an invite for a September meet, making it clear that the US is eager to do business here, but the cautious optimism prevails.
I think it's any indication of investor-friendly actions. There are so many U.S. companies that are already in India. There are other companies here that would be very interested in participating in the Indian economy, again, if there's a level playing field, if opportunities arise that are open as opposed to, say, perceived as being protectionist. And every indication is that in order for Mr. Modi to be able to achieve his goals, there is a concerted effort to make sure that markets are as open as they possibly can be in the best interest of India, but also offering greater opportunity to multinational investors.
In fact, it was last year only the downgrade threat by ratings agencies was looming large, with policy paralysis and decades-low growth putting pressure on the UPA's finance minister. And now the ratings agencies are eyeing the roadmap to recovery. The most scary is the S&P, which has warned India with its negative outlook, and any further decline would reduce India to junk status. On the brighter side, other rating agencies, including Fitch and Morgan Stanley, maintain a positive sentiment for the investment in India's economy.
And if you look at the weakness in the Indian economy, much of that has been a very weak story in capex, both public and private sector. You know, India does have a significant power deficit. It does need to build more infrastructure in many areas. And the corporate sector, you know, as demand picks up, is going to need to invest. So I think that the types of runs that we've seen in the engineering and construction stocks are understandable. And they probably will continue if we start to see orders being given out to these companies, which tends to be the main driver of the share price. I have a year-end target for the emerging market index, which is a return of about another 15%. I think India will outperform that. So maybe that gives you some guidance in the sort of magnitude of returns that I'm expecting.
There's a general recognition that investment has fallen off. That's one of the major reasons that the economy has slowed down so dramatically in the last 3 years. So if they're going to turn that around, there has to be higher rates of investment. The government doesn't have the money to do it all themselves, so they have to have some measures to promote higher rates of investment in the domestic private sector.
Even as foreign investors have pumped in around 1 lakh crore in this year, majority pouring in after the Modi government came to power, pushing the D Street to new highs. The investment outlook still remains far from absolute confidence, and the cash-starved India Inc. is hoping that India will be able to attract foreign investment.
What is most important and which takes a little time to pick up is the investment. And for the investment environment to happen, I would like to see in the budget the direction that they are taking. I think that would be a very big expectation. And once they deliver that, they have got a whole year to tackle issues and come up with reforms. Reform is not a one-moment process.
If you see the hike in the rail fare, the increase in the petrol and the diesel prices, so these are all indications of the fact that the government means business, that they are looking at a long-term growth rather than at short-term. And therefore, I would expect that they would continue the drive towards bringing down subsidies.
Overall, there should be a strong growth-oriented government, and the fiscal deficit containment, which may be required because of the incentives to be provided, should be managed through privatization and disinvestments.
But more than policy incentives, the need of the hour is a positive signal. Those who have ventured out to invest in India have pulled out after inordinate delays, protests and, in short, policy paralysis under the UPA government, denting India's image of becoming a business destination. And more than the budget, the foreign investors are hoping for a real change on the ground. The World Bank report has even pushed India at 134th spot against the 131. Lower than Brazil, China and Russia. From land acquisition norms or taxation or contract enforcement, investors have shied away in the past due to lack of a smoother, simpler, freeway to big-ticket projects.
We are expecting to hear measures to deal with fiscal stability. We want to hear how interest rates, inflation and foreign currency are going to be tackled. The government needs to create conditions for growth. Conditions for growth is a difficult thing to do, but we're expecting to hear announcements about infrastructure investment. We want to really see the burden of red tape in India. When our clients go to India, we get a lot of feedback on it not being an easy place to do business, so something that will reduce down the administrative burden of being in India. And finally, what we want to hear is something to deal with the current account deficit and the fiscal deficit and the ingredients to the solution of that.
And more than the budget, the foreign investors are hoping for a real change on the ground.
Let's not forget there is still the issue of the Vodafone, of Mitsubishi, still outstanding, which had nothing to do specifically with the retail issues. It has to do with consistency of policies. I repeat that, consistency of policies. You can't say one moment, yes, we will open, and then say, actually, no, we won't. In other words, what has been worrying FDI is not whether India is or is not welcoming foreign investment, but once policies are in place, you know that is going to be the regime of policies you will be operating under for the next decade, not just for the next 6 months, only this to be reversed.
I do realize there's a heavy burden of expectations on the government, but it is seen to be business friendly, and if Narendra Modi delivers only 1/3 of what he's been saying that he would deliver, I suspect that would bring us to the next stage of the uptrend in the Indian equities market.
We believe that the foreign institutional investor interest in India will sustain. It is important to note that the current level of interest is predicated on a few sectors and in fact even just a few stocks. As economic policy reform is articulated, executed and translated into actual earnings momentum in the economy, we feel that the investments by the FIIs will become more diverse and to that extent will become a little less hot.
There is no denying that the excitement over India is still high. From China engaging with the Modi government to Obama and the European Union pushing for bilateral trade ties. But with the world watching, will India deliver?